You've probably seen the ads, the constant stock picks, the hot tips, the influencer telling you to buy some small-cap biotech company before it, shoots to the moon. And meanwhile, the boring investor, the one with 3 simple funds and absolutely zero drama, quietly builds more wealth than almost all of them. Today, I'm going to show you exactly how they do it. Welcome to This Explainer, where we're going to break down a proven, incredibly simple investing strategy that uses absolute boredom as your ultimate investing edge. It's a strategy championed by some of the most respected names in personal finance. And by the end of this, you'll know exactly how to stop playing Wall Street's chaotic game and take back control of your financial future. So, let's get right into it.
Let's start things off with a pretty provocative question. Can you actually beat Wall Street? I mean, can the average investor, or even the highly paid professionals who study this stuff as a full-time job, actually outsmart the market on a consistent basis? We all secretly want to think we can spot the next big thing, right? But the actual data tells a vastly different story.
Get a load of this staggering number from the Spiva Scorecard report. The data actually shows that roughly 90% of actively managed mutual funds completely failed to beat the S&P 500 over a 15-year period. 90%. Just think about that for a second. If professional fund managers with literal armies of analysts and bottomless resources can't reliably beat the market, your odds of doing it by picking individual stocks in your spare time are pretty much non-existent. But honestly, this isn't bad news at all. It's incredibly empowering. It means you don't need to be smarter than Wall Street. You just need to stop trying to beat the market and simply start owning it.
Okay, real quick, here is our agenda for today. First, the problem with normal investing. Second, meet the 3-fund portfolio. Third, choosing your asset allocation. Fourth, why this strategy actually works. And fifth, rebalancing and staying consistent.
Section 1. The problem with normal investing. Most people approach investing as this chaotic mix of individual stock picks, maybe a few ETFs they sort of half understand, some hot tips from a Reddit thread, and a whole lot of chasing whatever the current trend is. This approach is completely driven by human emotion and hype. We try to predict what's going to happen next, but more often than not, all that complexity just ends up working against us.
And honestly, nothing illustrates the sheer danger of picking individual stocks quite like Intel. During the massive tech bubble around the year 2000, Intel was a high-flying tech darling. I mean, everybody wanted a piece of it. But if you had gone all in on Intel back then, you still wouldn't have broken through its all-time highs over 2 entire decades later. Now, contrast that stagnant, frustrating performance against the total stock market, which is up 5 times since 2000. With individual stocks, sure, you might hit a home run, but you are just as likely to strike out completely.
There's this famous quote from Jack Bogle. He's the visionary creator of Vanguard and the actual inventor of the index fund that perfectly summarizes our entire philosophy today. He asked, why look for the needle when you can just buy the whole haystack? Why exhaust yourself, risk your hard-earned capital, and pay ridiculous fees trying to find that one magical winning stock when you can literally just buy the entire global economy?
Section 2. Meet the 3-fund portfolio. So the absolute genius of this is that we can capture that entire haystack using just 3 simple, low-cost index funds. You really don't need dozens of separate investments to be perfectly diversified. You literally just need 3.
So here is the DNA of your new portfolio. Fund 1 is a U.S. total market fund. This holds thousands of companies, everyone from massive giants like Apple and Microsoft down to tiny local startups. Fund 2 is an international total market fund, capturing the 40% of the global market that sits outside the U.S. We're talking massive global brands like Nestle and Toyota. And finally, Fund 3 is a U.S. bond fund, which acts as your portfolio stabilizer when the stock market inevitably gets choppy. By combining just these 3 funds, you instantly hold over 21,500 different stocks and bonds across the entire world. You are globally diversified, protected against any single company going bankrupt, and there is virtually zero overlap. Now, depending on where you actually invest your money, the exact names change, but the strategy is exactly the same. Think of these ticker symbols like airport codes. JFK means New York, LHR means London. Well, these letters represent the exact funds you can use depending on your preferred brokerage platform, whether you're using Vanguard, Fidelity, or Schwab. And you can easily build this portfolio using either traditional mutual funds or exchange-traded funds, also known as ETFs. Section 3. Choosing your asset allocation. Let's see how this builds into your customized magic formula. Because owning the 3 funds is step 1. But deciding exactly how much of your money goes into each one, which is called your asset allocation, is where you tailor this entire strategy to your personal age and your specific risk tolerance.
For younger investors, a really popular rule of thumb is 120 minus your age in stocks. So let's say you're a 40-year-old. You might use an 80-20 split, which is a highly effective, growth-focused setup. You have 80% powering your wealth through global stocks while keeping a 20% bond allocation to slightly lower your overall volatility. When the market dips, and it definitely will, those bonds keep the entire portfolio from swinging too wildly.
Conversely, if you're a bit older, maybe nearing retirement, or honestly just looking to de-risk because you don't want to lose sleep over crazy market swings, the classic your age and bonds rule is extremely helpful. A 60-year-old might use a 40-60 split. This flips the script entirely, leaning heavily on those steady bonds for predictable returns and safety while keeping a smaller 40% stock allocation just to ensure your money is still growing and fighting off inflation over time.
Now, if you are a younger investor and you're tempted to just go 100% into stocks for maximum growth, you really have to be honest with yourself about your risk tolerance. Do you remember the 2008 crash? A 100% stock portfolio experienced a staggering 52% drawdown back then. That means your money was literally cut in half. And it wasn't just a quick dip either. It took over 1,800 days for that portfolio to fully recover its value. That is a massively long time to watch your life savings be down without panic selling. And that is exactly why bond allocations, even relatively small ones, serve as your ultimate sleep-at-night insurance.
Section 4. Why this strategy works. Now that we know what to buy and exactly how to balance it, let's explore why this beautifully passive, seemingly boring strategy mathematically crushes active management over the long haul. And a massive part of this comes down to something Wall Street really doesn't want you to think about: the fees.
Let's talk about the expense ratio. This is the ongoing annual fee charged by a fund just to manage your money. Passive index funds, like the ones we use in our 3-fund portfolio, are practically free. They often charge around 0.05%. Meanwhile, actively managed funds, where the so-called experts are picking stocks for you, routinely charge 0.75% or even higher. The historical data consistently proves that the single best predictor of a fund's future performance isn't its past success or some flashy famous manager. It is simply a rock-bottom expense ratio.
The data from the SEC starkly visualizes why these fees matter so much. If you look at a 20-year timeline on a $100,000 portfolio, an ongoing fee of just 0.25% will eat $10,000 of your hard-earned gains. A 0.75% fee, that wipes out $30,000. I mean, these seemingly tiny fractions of a percent will literally cannibalize tens of thousands of dollars of your wealth over time. It's crazy.
Let's make this even more real, because percentages can feel a bit abstract. Say you hire an advisor who charges a pretty standard 1% fee on your assets. If you invest $10,000 today and pay them that 1% every year for 30 years, it's going to cost you nearly $20,000 in fees and lost opportunity cost. To put that into perspective, that is the exact equivalent of buying 2,475 Chipotle burritos. That is roughly 6.5 years of eating a burrito every single day, completely gone, just for someone to likely put you in funds that underperform the broader market anyway. No thanks. Section 5. Rebalancing and staying consistent. Okay, we've built a portfolio and we've successfully stopped paying unnecessary burrito equivalent fees. Let's look at the only real maintenance job you actually have once this entire portfolio is set up on autopilot. Over time, the stock market naturally grows much faster than the bond market. So if you started with an equal split, pretty soon your US stocks will completely dominate your portfolio, which accidentally makes you way riskier than you originally intended. To fix this, you just rebalance once a year. Step 1. Identify which of your 3 funds are currently underweight. Step 2. Simply direct your new cash deposits to buy more of those lagging funds. Or if you're in a tax-advantaged account like an IRA, you can just sell a little bit of your winners to buy the losers. Step 3. Boom. You're instantly back to your original target allocation. It literally takes 5 minutes a year. You know, the true secret to this entire strategy isn't having the smartest, most complex spreadsheet or perfectly predicting international market shifts. It is simply consistency over complexity. It's automating your investments every single month, letting compound interest do all the heavy lifting for you, and completely ignoring the daily market noise, especially when the news inevitably looks grim and everyone else is panicking.
So as we wrap up this explainer, you really have a very clear choice in front of you. You can keep playing a losing game, paying incredibly high fees to managers who can't even beat the market, and stressing over which individual stock might pop next. Or you can just take an afternoon, set up your 3 basic funds, and let the entire global economy go to work for you. Will you keep frantically searching for the needle, or are you finally ready to just buy the haystack and take back total control of your financial future? The choice is entirely yours. Happy investing.